Somewhere in Miami right now, a nail salon that's rarely busy is reporting more revenue than a nail salon 3 times its size in Manhattan. Nobody's investigated it, nobody's asked why. And that's exactly the point because money laundering isn't about hiding cash in a mattress, it's about making dirty money look boring. And boring is the last thing anyone questions. Let's start with the basic problem every criminal enterprise runs into. Say you make a fortune selling something illegal. That money is real. It's spendable, but it's radioactive. You can't buy a house with it. You can't put it in a savings account. You can't even really enjoy it because the moment a bank or a tax agency asks, "Where did this come from?" you're finished. So, the entire goal of money laundering is to answer that one question with a lie so convincing it never gets asked twice. Financial investigators generally break the process into 3 stages, and understanding them is like understanding how a stain gets worked out of fabric. First, you introduce it into the wash, then you agitate it until the original mark is gone, then you fold it up looking clean. The first stage is placement. This is the moment illegal cash physically enters the financial system, and it's the single riskiest moment for anyone trying to launder money, because raw cash is loud. Banks in the US are required to report any cash deposit over $10,000 to the Financial Crimes Enforcement Network. So criminals get creative. They'll route money through cash-heavy businesses like car washes, vending machine routes, or nail salons, places where nobody blinks at a stack of 20s. This is also why so many real-world laundering fronts are oddly specific businesses. It's not because criminals love car washes, it's because a car wash can explain cash without explaining anything at all. The second stage is layering, and this is where things get genuinely elaborate. Layering is about distance. The goal is to move money through so many transactions, across so many accounts and borders, that by the time an investigator tries to trace it backward, they're following a trail that's been stepped on 1,000 times. Picture a river that starts as one clear stream and gets split into dozens of smaller channels that all reconnect somewhere downstream. By the time the water reaches the end, you have no way of knowing which drop came from where. One of the clearest real examples of this came out of the Danske Bank scandal in Estonia, where investigators found that roughly $230 billion in suspicious transactions moved through a single small branch between 2007 and 2015. Much of it tied to accounts in Russia and former Soviet states, bouncing through shell companies before landing in Western Europe. The money wasn't hidden in a vault somewhere. It was hidden in plain sight inside thousands of ordinary-looking wire transfers. The final stage is integration, where the money comes back out the other end looking completely legitimate. It gets used to buy real estate, invest in a business, or simply sit in an account as reported income. At this point, if anyone asks where the money came from, there's a paper trail ready to answer: invoices, tax filings, sales records, all of it pointing to a business that appears to have simply done well. Now, one method that shows up again and again in real investigations is called structuring or smurfing. The name comes from using a small army of people, sometimes family members, sometimes paid strangers, to each deposit an amount just under that $10,000 reporting threshold. Instead of walking into a bank with $200,000 and triggering every alarm in the building, you get 25 people depositing $8,000 each across different banks and different days. Individually, none of it looks strange. Together, it's $250,000 quietly absorbed into the system. Banks have gotten sharp to this pattern too. Modern fraud detection software actively hunts for clusters of deposits that sit suspiciously close to that reporting line because a normal paycheck doesn't usually land at $9,700 3 days in a row from different branches. Shell companies deserve their own mention because they're probably the single most powerful tool in a launderer's kit. A shell company is a business that exists almost entirely on paper. No real employees, no real product, sometimes just a mailbox and a registration certificate. On their own, shell companies are completely legal. Plenty of legitimate businesses use them for tax planning or liability protection. The problem starts when they're stacked. One shell company owning another, which owns another, spread across countries with strict banking secrecy laws. The 2016 Panama Papers leak exposed exactly how far this can go. revealing law firms that had helped set up over 200,000 offshore entities for clients around the world. Some completely legal, others built specifically to obscure who actually owned what. Real estate is another favorite, and it's easy to see why once you think about how subjective property value actually is. Nobody can definitively prove a house is worth $400,000 versus $600,000. That gray area is exactly what launderers exploit. Buy a property with questionable cash, hold it briefly, sell it, and now you have a clean bank transfer with a deed and a closing statement to back it up. High-end real estate in cities like Miami, London, and Dubai has repeatedly drawn scrutiny for exactly this reason, because luxury properties can absorb enormous sums in a single transaction, and in many places, buyers can purchase through anonymous shell companies without ever putting their own name on the paperwork. Casinos work on a similar principle, just faster. Walk in with cash, buy chips, play a little, cash out with a receipt showing gambling winnings. It's a plausible story built in under an hour. That said, this trick isn't the easy win it used to be. After several high-profile cases, casinos are now required to file suspicious activity reports on customers who buy large amounts of chips but barely gamble before cashing out, which is exactly the kind of behavior that used to slide by unnoticed. Then there's trade-based laundering, which is arguably the hardest method for investigators to untangle. It hides inside something that already involves huge, legitimate sums of money crossing borders every single day: international shipping. The trick is manipulating invoices. A company might claim to import a container of electronics worth $2 million when the actual goods are worth $200,000. That extra $1.8 million is really just a disguised money transfer wrapped in customs paperwork that officials rarely have the time or resources to verify line by line. Cryptocurrency gets brought up constantly in this conversation, and it's worth clearing up a common misconception. A lot of people assume crypto is a launderer's dream because it feels anonymous. In reality, most cryptocurrencies run on public blockchains, meaning every transaction is permanently recorded and, with the right tools, traceable. Blockchain analysis firms have helped law enforcement follow stolen and laundered crypto for years, including tracing funds from major exchange hacks back to real wallets. It's not that crypto can't be used to launder money, it absolutely has been, but it's far less of a magic invisibility cloak than the popular imagination suggests. Perhaps the most famous historical case tying all of this together is Al Capone. Capone ran an empire built on bootlegging, extortion, and violence throughout the 1920s, and law enforcement spent years trying and failing to convict him on those charges directly. What actually put him behind bars in 1931 wasn't a murder charge or a racketeering charge, it was tax evasion, because he'd failed to report income from his criminal operations. That case became the blueprint for how investigators still approach organized crime today. Sometimes proving where the money isn't accounted for is far easier than proving the crime that generated it, which is exactly why so many modern financial crime task forces work backward from suspicious wealth rather than forward from an alleged crime. The United Nations Office on Drugs and Crime estimates that laundered money amounts to somewhere between 2 and 5% of global GDP every single year. A staggering figure when you consider that's trillions of dollars moving through fake invoices, shell companies, and inflated property sales largely undetected. And that's really the core truth behind all of this. Money laundering isn't glamorous or high-tech most of the time. It's patient, it's boring on purpose, and it thrives specifically because it's designed to never look interesting enough to investigate. If this kind of breakdown of how financial crime actually works is something you find genuinely interesting, drop a comment with what surprised you most and hit like so more people can see how this stuff really operates behind the scenes.